and welcome back to another episode of Financial Planning Tips with Wall Street Alliance Group. My name is Makiah Hunt, and I am a Client Service Associate here. And today I have Johan Vako, Assistant Vice President of Wealth Management, and we're going to talk about Charitable Lead Trusts. So, Johan, just to start us off, can you just explain what is a Charitable Lead Trust?
Absolutely. Makiah, very nice to be here. So charitable lead trust is a type of irrevocable trust which allows you not only to make a charitable gift, but also benefit your family because you can design the trust in such a way that the family can get the remaining trust assets after a predetermined period of time. One question that I do get very often is that what are the contribution limits to the charitable lead trust? Just like in any other private foundation, let's say a donor advised fund or a charitable remainder trust, you can get a tax deduction of up to 30% of your adjusted gross income. And if it's for public charity, it's up to 50% of your adjusted gross income. But if it happens that you contribute in addition to that amount, the excess you can carry forward for a period of 5 years. Now, the beauty of the CLAT, Makiah, is that let's say you contribute $500,000. There will be scheduled payments to the designated charities that you may like for a period of time. For math purpose, let's say the payments are 5% of your contribution for a period of 20 years. So again, 5% of $500,000, $25,000 will go to charity every year for the next 20 years. Simple math, 20 years times 5%, 100% goes to the charities. But both you and I know, Makiah, that if we were to invest this money, let's say we buy S&P 500. The return on the S&P 500 for the past 20 years is about 10% a year. So the delta between the 10% growth and 5% that goes to charities will go to your family, estate tax-free after this 20-year period. In my opinion, this kind of strategy is very powerful for individuals who are charity-minded, whose net worth is substantial and are looking for ways to reduce their estate taxes.
Great. Thank you so much, Johan. So, how can someone use the Charitable Lead Trust for tax and estate planning?
Sure. So let me give you a couple of examples as of how you can use a charitable lead trust for both income and estate tax planning. Makiah, we have a client who is very charity-minded, and every year he was putting about $500,000 to a donor-advised fund. We sat down with the client and discussed with him that, is there any way that this $500,000 that you're putting to a donor-advised fund, your family can also benefit from it? Because when you use a donor-advised fund, all the money, including the appreciation, will go to charity. But the advantage of the CLAT is that the remaining assets go back to your family. Another advantage of the CLAT is that you also get some income tax savings. As you know, we have a lot of clients who do Roth conversions at the end of the year. Now, let's say you do $100,000 Roth conversion, there will be some taxes due. But if you put the same amount of money to the charitable lead trust in the same year, the taxes will offset. And lastly, there are estate tax benefits. In America, if both husband and wife pass away, there is an estate tax exemption of around $28 million. But if your net worth is above that amount, there will be some estate taxes, which are about 40% of the excess amount. There is a strategy called zero out estate tax strategy, where you can put the excess amount to a charitable lead trust, and the family will be getting the money estate tax free after a certain period of time.
Okay, great. Well, you spoke a bit on the advantages of the CLAT. So, can you just touch on what are some drawbacks to the Charitable Lead Trust?
Sure. So just like with every other advanced strategy out there, there are some pros and there are some cons. In my opinion, number one drawback of the charitable lead trust is that both income and gains are not tax exempt. What I mean by that is that if you do a lot of buy sell into the trust, it may not work out very well, because if you book a lot of gains, you will end up paying a lot of taxes. Also, you should structure your investments to be more growth oriented rather than income oriented, because both the dividends and interest are taxable. Number two drawback is that this kind of trust is irrevocable, as I mentioned earlier, which means that whatever terms you set up initially, it is very difficult to change. And number three is that there is an investment loss risk. You should have your investments done properly, because if you lose on the investment side, there will be no money left for the family, which is the whole purpose of setting up this kind of strategy. And of course, it is complex, it does cost money, so you should only use it if you really need it. I'm saying all that, Makiah, because we have seen people with a net worth of $2 million and they use a CLAT. So if your net worth is $2 million, in my opinion, you should have the basic foundation done. You should have a good estate plan in place. You should have a good financial plan in place. Then look for more advanced strategies. But if your net worth is north of $10 million, you are charity minded, your family is taken care of, you might be a good candidate to use a strategy like Charitable Lead Trust. So if you are in this kind of situation, sit one-on-one with your CPA, with your fiduciary financial advisor, who is also a CFP, and discuss if CLAT can make a difference for you.
Great. Thank you so much, Johan, for this week's financial planning tips with Wall Street Alliance Group, and we'll see you next week. Thank you.